to start. There are lots more people coming, I'm sure. But this is very exciting, and I'm sure that no matter when they come, they will pick up very quickly about the excitement of this meeting. As you know, this is a panel on the subprime problem. And the key question here is whether the problem will stay there or will grow into something which is much bigger. We've seen it growing already. We have three speakers here who would address those issues. And certainly here what we would like to get some elucidation is about what's happening now. Why is it that it has been become so widespread, the problem, when it started being a local problem? All of a sudden now we are talking about a credit crunch even at the global level. But it has very interesting characteristics. It's the first time, for example, that we have a global crisis not involving the emerging markets. So the question is why? What should we expect? Is it the end of it? Will the emerging markets be part of this? This is just a few of the many questions that we all have about this, and I thought together with my colleagues that we had here really tremendous brain power in situ, mostly. We have two of our professors here and a very distinguished visitor. Professors are Charlie Calomiris, who is very well known to all of you. He is the Henry Kaufman Professor of Financial Institutions. Rich Clarida, who is the Lowell Harris Professor of Economics and International Affairs. And he has been a former Assistant Secretary for Economic Policy in the U.S. Treasury from 2001 and 2003. And last but not least, one of our distinguished alumni, Vincent Reinhart, also very well known in these circles. He's worked for many years at the Board of Governors in Washington, and he has been Director of the Division of Monetary Affairs and Secretary and Economist of the Federal Open Market Committee. Now he's a free man. Believe it or not, he has retired, I think. I don't believe it, but so he'll be able to tell us some of the inside story. So I will ask them, each of them, to spend about 20 minutes with the presentations. That will take about an hour, but we have about 20 or 30 minutes more, and I hope to take that opportunity to open up the discussion to the floor. So let me go alphabetically. The first speaker is Charlie Calomiris. Charlie.
There's some ironies in the presentation I'm going to give today, because first of all, I think it's fair to say that more than any of the speakers here today, I've made my living as an academic trying to convince people that credit crunches, and particularly those that damage the financial system, are extremely important macroeconomic events, and that they're things that have mattered a lot in history and that continue to be risks throughout the world today. Nevertheless, the irony is that I'm probably going to be the most optimistic person on the panel, I predict, because I actually think that the problems and the risks are being substantially overstated and have been substantially overstated, and I'll talk about why. So I think the interesting part, if I can summarize my presentation, it is that credit crunches and capital crunches can be and have been disastrous macroeconomic events. There's good reason to worry, but then you also have to put your thinking cap on and ask yourself, when you understand from an economic structural standpoint how those crises work, is this one likely to be one of the bad ones? And I'm going to come out with a conclusion, a very dangerous thing for an economist ever to do, come to a definitive conclusion in advance of an event. But I'm going to come to the conclusion that it is not likely to be a very big deal. And the one of the consequences of that conclusion is that the Fed has overdone it and will continue to overdo it. And that makes the inflation risks, which are no longer a risk but a reality in the U.S., of very high inflation in the U.S. and continuing and accelerating, all the more worrisome. So there you have my policy lessons. I have a lot of other microeconomic policy lessons. Given the time, I know I'm not going to be able to get to those, having to do with ways to deal with the mortgage market from a microeconomic standpoint to try to resolve some of the distress. So maybe during the discussion period we'll talk about that. First thing to do is explain what happened. Since I was criticizing this whole intermediation mechanism long before the crisis happened, I can tell you what happened because I wasn't even particularly bright in predicting it. That is, it was clear that there were major problems relating to underwriting standards in subprime. Those were not just understandable ex post, they were understandable ex ante. They were bad credit decisions that were being made by bad bankers and that were being authorized and legitimized by bad credit rating agency modeling. They affected the markets, I'm going to go very quickly, through a variety of channels. The subprime credit was to a very large extent intermediated through securitizations, things called mortgage-backed securities. Those mortgage-backed securities are, to those who hold the securities, of course, a source of loss now. But it's worse than that because those securities were then re-securitized in creating things called collateralized debt obligations, or CDOs, which are basically just second and third generation securitizations. Yes, that's all they are. Taking mortgage-backed securities or other instruments, repackaging them into yet new conduits and issuing securities against those conduits. So we just have several generations removed. And as if that weren't bad enough, when the banks originated those CDOs, if they had a hard time selling some of the so-called A-rated or AA rated tranches coming out of those CDO structures, they would, if they had a hard time selling them, they would retain them on their own balance sheets and then fund those through these special conduits that they set up just to retain those unsellable CDOs, which they would then finance with commercial paper called asset-backed commercial paper. So the problem hit all of those markets, but because that underlying problem was being intermediated through layers of intermediation that expressed themselves once the underlying security was a problem in the form of a shock to the asset-backed commercial paper market, a shock in the CDO market, as well as a shock in mortgage-backed securities underlying those. Banks who were providing credit support for these various conduits and which had direct exposures through their portfolio obligations suffered, and there was a lot of concern, and there still is a lot of concern that we don't know where that's shaking out. That created what we call a lemons problem, an asymmetric information problem, adverse selection problem. They're synonymous, meaning that people felt that they couldn't figure out what the credit quality of the underlying intermediaries that were originating this process was, because it wasn't clear what the losses were. They weren't properly being recognized. They still aren't fully recognized, and so we're not able to figure out the risks of those underlying originators who retain a lot of that risk. Problem then being, how do we measure their credit risk in counterparty transactions like interbank lending in the LIBOR market? So that became a problem for liquidity generally in the banking system for a time. That's more or less resolved now. And then we had a collapse more generally. Once the emperor's got no clothes, the emperor tends to run away. Once it's been exposed that he doesn't have them. And so these problems, which I'll explain to you because they're not very complicated, of the way the ratings agencies were operating and the way this whole thing was intermediated, the poor underwriting standards, created a collapse of confidence in securitization, because securitization is a form of financial engineering, measuring risk, modeling risk, and then establishing leverage ratios that can tolerate the risk, and requiring other things like credit supports from institutions, insurance contracts, credit default swaps. All of these kinds of financial engineering products are now in disrepute. People don't believe the models which underlay the whole financial structure that engineered the claims that were being issued by various entities. And so the market for securitization has also dried up, which means the banks now are being asked to bring things back onto their balance sheet. The flow of originated loan products that banks would normally be putting through these securitizations, rather than devoting their own on balance sheet equity capital, they now have to devote their own balance sheet equity capital to intermediate. They may have an insufficiency of that equity capital. They certainly do relative to that pre-existing equity capital we know was insufficient relative to all the asset risk being originated by the banks. So when they try to bring it all back onto their balance sheet, that means there's an inadequacy in the financial system of equity capital. That's called a credit crunch or a capital crunch. It will tend to create a need to reduce the amount of risk being intermediated through those institutions. Unless, of course, they can raise capital, either by running profitable operations or by raising new capital. And so I would argue that the key question we have to ask ourselves, now that we've understood where this comes from, is whether there's going to be a sufficient availability of equity capital to financial institutions that's going to allow them to reabsorb enough financial risk so that we don't get a terrible capital crunch, credit crunch, coming from this scarcity of equity capital. That's the whole question. That's the story of how we got there. I could tell you some wonderful things about it. If you want to see pictures about how quickly things happen in CDO issuance, I'll show you some pictures. Given that I have 20 minutes, I'm not going to do much of that. You can see that the problems related to commercial paper having to do with those leveraged super senior tranches that I talked about, the Gresham's Law problem, keeping the worst stuff on balance sheet and financing with asset-backed paper. You can see that there's a huge falling out of bed of the asset-backed commercial paper market, not the non-financial commercial paper market, not even very much what finance companies were doing. It was the large banks doing huge amounts of asset-backed commercial paper to fund this working capital coming off of this intermediated stuff, these tranches in the CDOs in particular. But you can see that's leveled out. So we fell out of bed, it started to progress, and it's no longer in free fall. Pretty much, I'll show you some other graphs that make the same point. From the standpoint of bank credit risk and counterparty risk and concern about banks' abilities to operate in money markets, we have resolved the problem, meaning that we no longer see free fall in what's happening in the money markets related to banking. You'll also see that in terms of the spreads banks charge each other for funds. But the deeper question is whether we will have resolved the equity scarcity. So I'll come back to that. I do want to just say this is not a new phenomenon. The severity is new, but securitization always or often involves a learning process where new products, their risk is underrated, their risk we learn about in time, and then the ratings agencies remodel the risk, and we then go back into a steady state. That has happened with many, many products. I teach securitization in advanced corporate finance, and I love, even before this crisis happened, teaching crises. They're all small little crises none of you have ever heard of that happen with most securitized products. Because ratings agencies, the people who are really smart aren't working for the ratings agencies. They're working for Goldman Sachs, okay? The ratings agencies, I hope that they didn't get that on film. But they're my friends, and I love them. They're actually much smarter than the people who work at Goldman Sachs. But, so anyway, novelty combined with some other problems that have to do with the regulatory use of ratings, which has created incentives for ratings agencies to inflate ratings, and also combined with, I think, some desire to get fees, led to the ratings agencies using some practices that didn't make sense even before the crash. For example, BBB CDOs. BBB CDOs, as of 2005, their history of default was 20%. As of 2005, a BBB instrument written on a CDO, 20%. BBB corporate debt, 2%. So the point here is there was a reason for this having to do with regulatory arbitrage. We don't have time to talk about it, but there was a regulatory failure having to do with, in my opinion, inappropriate use of ratings in the regulatory process. There's also another thing, which is myopia. I'll show you this in a graph in a minute. When was the peak of foreclosures in subprime lending? Here it is, 2001. Subprime foreclosure inventory peaks 2001. That's not what you were thinking, right? You were thinking, you don't remember this story in the news, and you remember this story. Well, this is a mortgage foreclosure rate. The inventory of foreclosed mortgages relative to total outstanding in subprime peaked in 2001, 2002. That's very important. There were a small amount of them. but the foreclosure rate peaked. And what did the ratings agencies learn? They learned that the losses were zero. So that's how you got liar loans. There it is. That is the picture of liar loans. The way you got no underwriting on loans was the belief that the loss given default was so low, 5 or 6%, that the probability of default was irrelevant. Of course, that was reflecting the fact that the housing market was booming in 2002, 2003. So that when you sold the house after you foreclosed, you didn't have loss, irrespective of the characteristics of the borrower. Now, that was why I criticized them prior to the crash. This assumption that you could use the loss given defaults, remember, this product's only been out for 10 years, that you could use the loss given defaults from this when there'd never been a cycle before of experienced losses where the housing prices weren't booming, was idiotic, ex ante. But really not idiotic, because they're my friends. They were just making a mistake. Okay, so we've already talked about this. I'm much more optimistic about the housing market. We're not going to have a lot of time to talk about it. I'll just say that I think that there are lots of flaws in the way that the housing prices are being measured. I know the Case-Shiller Index is telling us that we are down 10% from the peak. I believe that's an overestimate of the average decline of U.S. housing value since the peak. I believe that the OFEO Index, which shows that we're basically flat, haven't really declined much, is a better indication of where we are from the standpoint of what we should care about as macroeconomists. I think this is an important story that needs to be told, but I don't have time to tell it now. The main thing I want to leave you with is, having written quite a few things about credit crunches in the past, the 1930s and the 1989 to 91 experience, where Ben Bernanke also made his reputation in large degree. I want to point out, this is nothing like that time. There are many differences having to do with the diversification of risk throughout the financial system that's much better. Also, banks are making money. In the early 1990s, banks were losing money on an ongoing basis and had existing losses. Banks today, from a revenue standpoint, are generating profit. It's all a question of recognizing past losses. That's important. Also, there's a great reservoir of liquidity out there now called hedge funds. As I had breakfast with a Wall Street guy who shall remain nameless, especially since we're on film, who said, hey, this is all basically a face-off between the hedge funds and the existing old-fashioned financial institutions, and it's all about the bid and the ask being too far from each other. In other words, they've got enough money to come in and recapitalize the banks by making equity investments. It's just a question of price. Why is the bid and the ask different? Because of asymmetric information, because of opacity, because we don't know exactly the incidence of the losses the banks have faced. Over the next 3 months, if we get a stabilized view of that, based on reporting of earnings, if we do, which I think is a reasonable possibility, we're going to see those bid and ask get a lot closer, and we've already seen something we never saw in this previous period, which is almost $50 billion of new equity being raised by banks, in addition to the prospect of ongoing profits. That is not 1989 to 91. Of course, things can get worse. I'm going to leave it to Vince, and I'm guessing Rich maybe too. They can tell you lots of nuclear meltdown scenarios, vicious cycles. I would say I think those are things to worry about. It could happen. I give it a 10% or less probability. So another thing that's very different from 1990-91 is this is lending. All commercial banks, and these are the weekly reporting large domestic commercial banks. That's not a credit crunch. Lending, at least in terms of what's on the balance sheet, has been growing and continues to grow. Now, of course, it grew a lot faster from August to October than it has since October. But it's still growing. So the key question now is, the banks finally are getting to their debt capacity limit. They don't have any more capital to absorb it. They need new profits and new capital being generated from that bid and the ask closing. It has been happening. I believe it's going to continue to happen. Key point here is, if you thought the mortgage market was a disaster, bear in mind that these interest rates, if you're in Latin America, none of these looks very high. Okay? And the jumbo rate, which is the higher one there, is still now, because the Fed has reduced interest rates so much, that rate, while it is still high, is not outrageously high compared to what it was even back in July and August. The key issue here, I don't have a lot of time for this, I would say this was the biggest thing that worried me, and it's pretty much gone away. That is, very high at some periods spreads in the LIBOR Fed funds market, showing us that large banks didn't trust each other or couldn't spare the capital for each other in the overnight market. We've had a couple of scares with that, but that seems to have stabilized recently. This is another thing people don't point out. My friend Hyman Minsky, after which this presentation is lovingly named, always pointed to corporate leverage as an important part of the story of how a shock gets translated into this vicious cycle downturn. The good news is that because of the 2003 tax changes, which were largely motivated to reduce tax motives for leveraging, that's what the dividend tax was all really about. And it worked like a charm. So corporations' debt capacity has returned to what was prior to the 1980s. Remember the 1980s? Big buildup of debt that persisted. The tax policy changes that people like Rich helped engineer for us have succeeded in reducing that leverage and vulnerability, meaning there's a lot of spare cash, there's a lot of spare debt capacity for for non-financial corporations to raise in the bond market. And remember, those hedge funds are out there with huge reservoirs of capital. So, I've talked about this. This is all about the housing price indexes. We don't have time for that. Housing net worth per capita, if you believe that the OFEO index is an accurate way to measure, because that's underlying this, is still at an all-time peak. Now, leverage of housing is high too, but I just want to emphasize we're a wealthier society by far than we were even when this crisis started, you might say. So, assuming housing prices don't fall out of bed. Another reason I don't think housing prices are going to fall out of bed is this crisis is happening at a time after housing starts had already been in decline for a year. Yes, inventories of housing, unsold housing are high, but the new pipeline of housing had been cut off for a year prior to this. And I think that the inventory is a very misleading number. I have another paper I'm doing right now on the relationship between housing price returns and inventories using state level data for the last 20 years. I don't believe that the inventory of housing number is giving us the kind of clear negative reading that many people think it is. The most obvious indication of that is housing markets that are going up still, Seattle and Austin, also have very high inventories of unsold homes. That's reflecting high uncertainty on the buying side, not necessarily a negative direction in prices. So recession risk, I think, is minimal. I have some other slides about that. Give 30 seconds on policy. I think the policy response of the Fed has been aggressive. To a point, I thought appropriately. I think in the last week, especially given the chairman's testimony yesterday, I think it's gone too far, and I think that the Fed, it's a political, I'm sorry, I'm being taken, no one at the Fed would ever act politically, nor would they be pressured by Wall Street people talking their book who want to have lower interest rates. I'm sure that would never happen. So I'm very concerned right now. Inflation has been accelerating. I think we've overdone it. I would recommend to you Alan Meltzer's article in today's Wall Street Journal, which I share the sentiment very, very strongly. There are a variety of microeconomic implications that I think are important that come out of this, and I'd love to talk about them, but I'm cognizant that I've used up. How much have I used? I've used it. So, thank you for your attention. I look forward to hearing what my colleagues have to say.
It's a treat to be on this panel because it gets me out here to actually hear from Charlie and Vince, and so I'll offer my takes. And I think this will complement Charlie's talk, and I hope Vince's talk, because I'm going to try to provide some macro context. My expertise is more in global macro than in the microeconomics of securitization, where Charlie really is an expert. But there is, I think, some interplay between the two that I'll try to discuss with you. So let me start with where I think we are. I do think that the economy is on the edge of a recession, a word that Greenspan used a week or so ago. And that Fed ease and fiscal stimulus, both enacted and in the pipeline, may not be enough to turn it around. I, for one, do think that if we do have a downturn, it could look a lot more like 90-92 than 2001-2003. Unlike in that last episode, which I lived through as Assistant Treasury Secretary, I don't think we can count on the consumer to come to the rescue. And of course, in the absence of a consumption support, then can exports and capital spending fill the gap? Okay, now how did we get here? And this is where I'd like to talk about a little bit of context, because I think I broadly agree with Charlie's presentation, but I also think there was a macroeconomics context that interacted with some financial innovation to get us to where we are today. So I'd like to cite several factors that I think contributed to where we got to today. Number one, I think you have to go back to 2000. We had the bursting of a global equity bubble, and that begat a global policy response, and basically a very easy, accommodative monetary policy, which was entirely appropriate. And I was very thankful in 01, 02, and 03 that the Greenspan Fed was easing rates, because that was the appropriate response to that shock. So that policy worked in the U.S., in Europe, and abroad. Also in Japan, of course, remember, they couldn't cut interest rates because rates were at zero, so they went to Plan B under Fukui and flooded the financial system with excess liquidity. But I think that this policy response had some consequences, as policy responses do. It led to, contributed to, I think, a period of compressed risk premium, chasing yield, global imbalances, and as I'll argue in a moment, credit market excesses. I'm not second-guessing the Fed. The policy response was appropriate, but there were some consequences. I think it's also important to remember that another factor driving global financial markets in the last 5 years has really had nothing to do with the Fed. It's what Bernanke has called the savings glut. I and others were writing about it several years before that. It's simply the recognition that we're in a very unusual period where rapidly growing emerging economies have spectacularly high savings rates relative to an investment. That saving is flowing into the global capital market, and it's driving down global interest rates. And I'm very much in the camp that thinks that there is a savings glut capital account side to the U.S. current account deficit. Remember, in the year 2000, we already had a current account deficit of 4% of GDP before the savings glut. But I do think a lot of the widening of that deficit from 4% of GDP to around 7% of GDP was related to the savings glut. The mechanism is very simple. Global savings rises, drops down interest rates. Those countries like the U.S., which have elastic financial markets that can translate low rates into consumption and housing, will tend to spend it. And notice we had a widening deficit, lower interest rates. Correlation is not causation, but I remind you that in the 80s and the 90s it went the other way. Big current account deficits, high interest rates to suck in the capital flow. Another factor is related but distinct from the savings glut is that the countries that save a lot also have fixed exchange rates. Okay, and we focus on China, which is a big part of reserve accumulation. But the other big story the last several years has been petrodollar recycling. So this is an IMF chart. This is the U.S. current account deficit of a share of global GDP. The blue line here is emerging Asia. But the big story really is, it's hard to remember, but as recently as 2000, the aggregate current account surpluses of the oil exporters were zero, and they're now even bigger than emerging Asia in terms of their impact on the global economy. And so we essentially had a second round of savings pouring into the global financial system. Initially, it was an Asian development phenomenon. That then pushed up commodity prices. Those surpluses got recycled, lowered interest rates more, and I think also created an appetite for exotic finance. There's a lot of attention on whether or not the U.S. imbalance is sustainable or unsustainable. I had the privilege of directing a project for the MBER several years ago on G7 current account imbalances, and one of the themes that emerged from that is that looking at the difference between these two lines is important, but it can also obscure what's going on with the gross capital flows. So the top line here are gross foreign holdings of U.S. assets, and the bottom line here are gross U.S. holdings of foreign assets. And so we're really in a decade now of spectacular exponential growth in global capital flows, gross flows across borders. The other interesting thing, and again, this I do an entire lecture on this, so I don't have time right now, is the fact that, notwithstanding the fact that the U.S. has run a current account deficit in excess of $500 billion a year for the last 6 years, our net international liability position has not worsened. Indeed, it's narrowed. We have a smaller liability than we did 6 years ago. As in a share of U.S. or global GDP, it's much lower. So how can you run current account deficit $600 billion a year and have a narrowing liability? It occurs for two reasons. One, because dollar depreciation tends to be stabilizing in this world through its revaluation. And secondly, the U.S. has a different portfolio abroad than foreigners invest in the U.S. So we own a lot of foreign equities, a lot of foreign FDI. Foreigners, until recently, owned a lot of T-bills. And there's no theorem in finance that says if I own Asian equity and Asians lend to me at a T-bill rate, we're going to earn the same rate of return. So if you go to the Commerce Department data, which they publish every July, you'll see the way that they account for and reconcile large current account deficits with a narrowing international liability position. But to me, the big story here is this hockey stick takeoff in gross capital flows. So what did all this add up to? Well, Charlie did a very good job, and I'm glad to follow him, in laying out the innovation in securitization. So all those innovations were there. But if the supply of something goes up, other things being equal, you'd expect the price to go down. And in finance, the yield to go up. So how was it we had all this financial innovation, all this product that Charlie showed the chart for, and yet the price kept going up, the yield kept going down, because of all this hot money chasing these opportunities. And so, oops, I skipped ahead one slide. So my point is that, yes, we had financial innovation, but we also had a period of exponential increases in gross financial flows, chasing returns, lowering risk, encouraging people to increase their leverage, and essentially creating an excess demand for exotic finance. So I think the supply of exotic finance was there, but this, even though these securities were originated in New York and to some extent in London, they were distributed globally. And many of the sovereign wealth funds that you read about now in the financial press, especially those in the Middle East, were actually very active purchasers of this product. Okay, so that's my context for how we got to where we are right now. Now, although the housing bubble actually started to deflate in 2006 and residential investment started to decline, financial markets and policymakers really did not start to notice until the spring of 2007. I had dinner in July with a Fed governor. I won't mention which one, but I had dinner with a Fed governor in July, which turned out coincidentally to be the day that Moody's and S&P announced that they were revising their rating methodologies for these CDO structures. And we had a very informed and lively conversation about it. But I think it's fair to say that this Fed governor, I would characterize him as being very, very relaxed in July about whether or not this would have a macro consequence, about whether or not this was anything more than a subprime problem. So obviously this governor did not necessarily represent the entire board, but there was at least one governor that was not at all particularly concerned about what was about to happen a month later. I remind you, and I'm sure Vince will want to discuss this, that as late as the first week of August of 2007, the Fed's statement emphasized that it was quite concerned about inflation risk, and then only 10 days later, the statement coming out of the Fed was much different, and we had a 50 basis point ease in September. So right now, coming back and bringing this into macro economics, so putting it back to the 30,000 foot level, if I'm teaching a course on macroeconomics, you talk about the way the economy responds to shocks. And right now, the economy is being hit with four distinct, interrelated but distinct macro shocks. So number one, the housing market has turned. It's a decline in aggregate demand. There's a decline in house prices, which may further have a wealth effect on consumption. So that's a macro shock. That's a textbook macro shock. The ICE curve shifts left, or the AD curve shifts left, depending on which textbook you use. The asset-backed securities meltdown is a financial markets shock, and it has really moved way beyond just CDO and other structures that are securitized by mortgages. It's really any product that uses the ratings methodology of tranche securitization is selling off and does not have an active market for it right now. And that's why we have contagion, because even though mortgages aren't like credit cards, aren't like auto loan receivables, they all shared or aren't like leveraged loans for LBOs, they all shared one thing in common. They all use the same ratings methodology and the same set of assumptions about correlations or lack thereof to assess the ratings that these securities got. So this is a very well understood financial market shock. It's increasing the cost of borrowing. relative to what it was. Oil is at 90, yesterday at 100, so oil is a supply shock. And I think this is now, I think the move from 85 up to 102, to me, looks more like a supply shock than a demand shock. And again, we'll never know because econometrics will take 20 years to resolve this, but my gut feeling is that this last move in oil prices is really a supply shock because it's occurring in the context of slowing U.S. economy, the IMF and Europeans marking down growth outlook for Europe and the like, and yet the oil market keeps trading up in price. And then finally, that I would argue that the term funding shadow Minsky banking system that Charlie referred to is a distinct shock, which is a banking shock. And I would distinguish between a banking shock and a financial market shock. For example, in 1998, we clearly had a financial market shock with long-term capital, Russia, Thailand, Asia, name your country, but the banking system was fine. LIBOR spreads did not materially move for any prolonged period of time, other than maybe a week or two in August when the traders are at the Hamptons. So you can have financial market shocks without banking shock. Usually if you have a banking shock, you're going to have a financial market shock too. So I certainly couldn't have this and say, well, financial markets are fine. But I think we've got a twofer right now. So if I were at the Fed, if I were Assistant Treasury Secretary right now, I would be concerned just based upon what I'm up against, right now. Now these are just some charts to show you sort of the magnitude of what some of these headwinds are. This is some street research that's essentially computing a relationship between home sales and the difference between home price appreciation and mortgage rates. So the idea is if interest rates are high but home prices are going up, the cost of owning a home is not so substantial. Well, we have a situation now is where although mortgage rates are more or less where they were a year ago, home prices are falling, and thus the real cost of owning a home has gone up. And obviously it will take some time to see whether or not the turnover matches this big reduction in affordability, but certainly that's a continued headwind to the economy. Another, as I mentioned, is the fact that this is occurring in the context of high and rising oil prices. One thing that's interesting about the oil market is that the spot price is usually above the spot price is usually above the futures price, but this began to change in 2005 when the futures were trading above the spot. So you thought oil at 75 was expensive. Well, the futures market was saying it's going to be even more expensive a year from now. You'll see that that is actually quite unusual, at least going back the last 20 years or so. Interestingly enough, this summer in August, even though oil prices are going up, the future markets are saying, we're not quite sure if we believe it. So futures are now trading below spot, spots above futures. So that's the difference. The key point, though, is that, again, we see oil prices going up, and then, again, in the context of a slowing global economy. I'll come back in a moment about whether or not this is a potential inflation signal. As I mentioned, there's a credit shock now. It's more expensive to borrow, whether or not you're an industrial firm, whether or not you're a financial firm. Now, these are credit spreads, and that's important because these are spreads relative to the level of rates that are falling. But as the previous chart showed, mortgage rates now in the U.S., even for conforming borrowers, are above where they were before the Fed started to ease. And it would be hard to find a recent economic cycle in which that you've had such Fed easing, and yet even conforming mortgages are above where they were before the Fed eased. And then finally, you have this financial dislocation that I talked about. These charts are a little bit out of date, that they're at the end of 2007. It is still the case that the spread between interbank borrowing rates, the LIBOR rate, and Treasury securities, the gold standard of riskless assets, is very wide. It's more than 100 basis points now. It's narrower than it was in August when it was around 200 basis points, but still I think there is some indication of continued stress in the financial system, although I would say that the Fed's Treasury auction facility was a very important contribution, and I think going forward probably will take the role of the discount window, but I look forward to Vince's comment on how that came about. Now, right now, if you just sort of look at the consensus forecast, this is taken from Bloomberg, so they poll 50 people each month, and this is data as of yesterday. So as of yesterday, the point estimate, again, you've got people above this, people below, but the median point estimate was not for a recession. This is annualized quarterly data, so Q1 of 2008 moving up to around 2 to 4 to 6. I think you don't want to put too much emphasis on this because in my professional career, dating back to the early 1980s, I don't think there has ever been a recession where the consensus forecast has actually foreseen negative growth before it occurs. I can share a personal reflection with you. When my first day on the job at Treasury was in September 11th, 2001, and you all remember where you were, and I still remember where I was, and meeting with then Secretary Paul O'Neill saying, well, Rich, what I know is, are we in a recession? At that time, we didn't know we were in a recession. The Fed didn't know we were in a recession, and you can go back and look at the transcripts on that. After September 11th, we thought, if we're not, we're probably in one now. It turns out that months later, our friends at the NBER declared that the recession had actually begun in March of 2001. And I can tell you, on September 10th, the Treasury Secretary and the Fed Chairman did not know that for sure. It was a probability. So again, take this with a grain of salt, but that's where the consensus is. A couple of other comments before I conclude up. Obviously, I began by talking about the global easing cycle, which was, I think, appropriate. We then, of course, had that followed by a global tightening cycle in the UK and the Bank of England, and even our friends at the BOJ managed to raise rates twice, all the way up to 0.5% per year, which is where they stand now. And we're on the next easing cycle. Obviously, the Fed has eased aggressively, cutting rates down all the way down to 3% from 5.25. The Bank of England has now eased twice. The real focus is on the ECB. Will the ECB move next? There are competing pressures over there. One pressure on the ECB to ease is they have a big subprime exposure. For whatever reason, German banks love this stuff, and there's a lot of the most exotic, convoluted structured product in the world that was developed here in New York was eagerly acquired by the Germans. So, if you speak to policymakers there, they're cognizant of the fragility of their system. There's some evidence that the European data is slowing. On the other hand, the ECB is very committed to not letting inflation get out of hand, and thus far they've not been persuaded that they need to ease preemptively. And of course, in Japan, there's very little room to ease. Finally, the dollar. The dollar's been on a downtrend really since 2001. Oftentimes people say, oh, well, exchange rates are coin flips, they're random walks. Why do you spend your career doing international macro? And I think it is true if you look at an exchange rate day to day or hour to hour, it does look like a coin flip. But if you step back and look at periods of time, you see some pretty understandable relationships. So from 2001 to 2004, the dollar was declining in a period of slow U.S. growth and Fed ease. From 2004 to 2006, there was really no trend in the dollar, sort of sideways. And what happened there? The Fed was hiking, we had strong U.S. growth. So those factors more or less counterbalanced the drag that you'd otherwise see from the current account deficit. And then since June of 2006, which was the last Fed hike, and now of course we're in a Fed easing cycle, the dollar's been declining with slower U.S. growth and easier Fed policy. So I think the dollar downtrend will continue. I'm not in the camp that sees a crash landing of the dollar or sees a fire sale. It's not a zero probability event, but I think it is unlikely. And I should point out that the adjustment thus far has been orderly. The U.S. current account deficit as a share of U.S. GDP peaked at around 7% in mid-06, and it's now at a run rate, if you annualize the current numbers, of around 5%. I can tell you that in a recession scenario, and moreover in a recession scenario where oil prices fall because of perhaps slower growth, a big part of the increase in the U.S. current account deficit the last 3 years was the oil import bill. And if oil prices were to go to, say, 70 from 95, you'd see another percent of GDP narrowing of the U.S. current account deficit. So I think we've actually made more progress on this than the financial press indicates. So concluding thoughts, I don't know if we're in a recession. I'm probably more pessimistic than perhaps Charlie is. I think if we do go into a recession, it will look more like 1990, 92, where we actually had a decline in consumption and not just a slowdown in capital spending. Clearly, global capital markets, we can debate till the cows come home whether or not the global economy is going to decouple or recouple, but global capital markets, because of this common securitization shock, are clearly coupled. I think the Fed will continue to ease at least as much as the markets think, but it may not be enough. I'm not particularly optimistic about the fiscal package that was passed or additions to it that may be down the road, and I think the dollar will continue to decline. So on that, I will conclude. Thank you.
So because of the tyranny of the alphabet, most of what I wanted to say has already been said. So think of this as vantage point, the subprime story. I'm going to show some of the same charts and have a slightly different take. And what you're going to find out is, unfortunately, if you like controversy, I'm just between Professors Clarida and Calomiris. Although I think that there are important interpretation differences depending on where you sit. So I'm going to briefly talk about the main source of drag on the U.S. economy, examine the transmission through financial markets, outline the spillover to the rest of the world, and discuss the policy response. Now, the housing correction, I'd like to step back and talk about a decade-long story. And the decade-long story is fundamentals supported housing demand for much of the 1990s and the early 2000s. Why? We had strong growth in disposable income, real mortgage rates were low, demographics were favorable, don't forget that. The baby boom generation was aging, and our nation had a large influx of immigration in the prior 8 to 10 years. That meant there was big demand for second homes and for starter homes. And then lastly, house prices increases created the expectation of capital gain. It's sometimes said that all Americans want to own a home. That's not true. All Americans want to get rich quick. And a leveraged bet on housing is exactly the way to do it, particularly when you think about some people have limited avenues for wealth creation. Housing is not a limited avenue. So what happened? Our economy shifted resources to supply that elevated demand for housing. This plots the share of employment in construction and finance, and it increased about 2 percentage points over a decade. And think, the denominator in that calculation is about 110 million people. So it was a large shift of resources to build and support the financing of houses. Worked pretty well for a while. But around 2006, well, in 2004 it started, the Federal Reserve started raising rates, income growth slowed, the nation looked less favorable toward immigrants. For a while, supply was maintained by shifting toward adjustable rate mortgages and more novel products with teaser rates. Indeed, you could even argue that the Federal Reserve's policy of gradualism created just exactly that intertemporal bargain to finance down at the short end of the yield curve. But more than that happened. Standards of lending standards and terms were eased, and indeed, in some cases, it was outright facilitation of fraud. So the boom continued for a while, but supported less by fundamentals, and then house prices stopped appreciating. What happened around the end of 2006, beginning of 2007? The extent of overbuilding and lax lending became evident. House prices stopped appreciating. Mortgages made in the class of 2006 performed terribly, and housing demand fell off, creating this large stock flow imbalance. This, by the way, is the point Charlie made. The Case-Shiller index is clearly a house price indicator without a lot of amplitude, but even the preferred measure, the one coming from Ofeo, is now dipped its toe into negative waters. So the first drag on the U.S. economy is the effort of builders to cope with bloated inventories, and that will slow. It has been slowing spending, and it's been slowing spending for a while. The adjustment of house prices creates 2 additional drags. Why? House prices is an important part of household wealth. This is the aggregate household balance sheet. And as of the third quarter of last year, $23 trillion of household wealth sat there. So a 10% drop in house prices lowers wealth by $2.25 trillion. And if you think wealth matters in informing spending decisions, then that's a second drag. But there's a third one too, and that is when some households see the main asset on their balance sheet depreciate in value, they walk away from their main liability, their mortgage. And that's the financial strain, and this basically is how Main Street affects Wall Street. Now, we would think then we're in the midst of elevated defaults on mortgages, subprime and all mortgages, and probably, estimates put that somewhere in the range of $200 to $400 billion. We've seen that already in terms of mortgage delinquency rates. Again, the class of 2006, the cumulative defaults on subprime mortgages, these take off like the space shuttle. And that's telling you that the terms and standards on these mortgages were deplorable. So we're going to have defaults in the neighborhood of 200 to 400 billion. That leads us to the financial market. That was Main Street. What about Wall Street? And this is, mortgages serve as collateral for a lot of different instruments, right? And this poses a riddle wrapped in a mystery inside an enigma. What's the riddle? What are securities backed by mortgage collateral worth? Well, what's the mystery? Who holds them? And then the enigma is, how will market participants react? So the issue is, we have complicated securities held by entities with opaque balance sheets. They're not sure of their overall losses. They're not sure the price of this stuff. They similarly suspect their major counterparties are in likewise situation, and so we see a withdrawal from risk-taking. That withdrawal, increased uncertainty and withdrawal from risk-taking multiplies the economic loss, that's the defaults, into the market loss, which will be a multiple of the $200 to $400 billion economic loss given default. Now, this withdrawal from risk-taking applies both to securities and to firms. Securities, what I mean is complicated instruments that are part of this market have deteriorated sharply in price, and that for a time financial institutions were mistrustful of lending to each other. And as you can see, this is a similar chart to actually both earlier presentations. This basically is telling you that large, complex financial institutions had a desire to shrink their balance sheet, conserve on capital, and were not willing to take advantage of arbitrage opportunities. Now, to step back, the acronyms might be new this time, but financial markets are amplifying a real shock in a very familiar manner. And the problem is market participants almost always underprice their exposure to withdrawal from risk-taking. In 1987, sophisticated firms thought that they could hedge risk through portfolio insurance. That required there being a market there at every point in time. But when the market moved discontinuously, what they thought was a hedge wasn't there. What did LTCM do in 1998? They basically sold insurance on a withdrawal from risk-taking because they took very leveraged bets that that risk spreads generally would narrow toward historical averages. The GSEs, there was a run-up in volatility in 2002 and 2003 that was associated with concerns about the government-sponsored enterprises, Fannie and Freddie. They thought they were using dynamic hedging to control their mortgage risk rather than buying outright static hedges. They didn't price appropriately their exposure to a withdrawal from risk-taking. What's happened this time? This time round, CDOs didn't perform the way people thought when the market for them dried up. They assumed there would always be a market, there wasn't. Large, complex financial institutions created off-balance sheet entities with the sole design of borrowing short and lending long. assuming the borrowing market would always be there. And now we have auction rate preferred instruments, which are essentially created the illusion of long-term debt, but repriced every 2 weeks to every month. Now, this brings up some external issues, because what we're in the midst of seeing is a perfect example of global risk sharing. We have had, as Rich said, been running a very large current account deficit. Large current account deficits have to be financed by large capital account surpluses. Foreign official entities have tended to purchase huge volumes of US government securities as part of their exchange intervention strategy. What does that create? That meant that the global investor, the private investor, wound up increasing its exposure to US credit risk. Indeed, you might even think the financial engineering was in part endogenous. We had very large current account deficits. We were selling a lot of IOUs. The really good, high-rated IOUs, that is government securities, were being socked away by foreign official institutions. Other foreign institutions wanted similarly rated securities, in part so they could take advantage of regulatory arbitrage. They could fund those AAA securities at essentially a deposit rate. What happens then? Since the governments were buying up, other governments were buying up US governments, they went to Wall Street and they manufactured AAA securities out of the bits and pieces of mortgages. Now, the other thing to remember is, again, the net and gross distinction. The net flows are huge, but the gross flows are even bigger. And so there's been a large exchange of risk across country. That means, so in terms of the financial part, there's two things to recognize. First, the economic loss, that is mortgage defaults, is being multiplied right now because there's been a withdrawal from risk taking, so the market loss is even greater than the $200 to $400 billion default. That also means, by the way, when you tick off the list of large institutions that have already admitted losses, it comes up to about $200 billion. But they're not working to that fixed point of $200 to $400 billion default loss. They're admitting a market loss, which could very well will be a multiple. So the first thing is there's an economic loss, defaults. It is shared globally because we have open global capital markets. We have been running a current account deficit. That means we have to sell IOUs. Now, that adjustment is important because the external adjustment provides a cushion to US economic activity. The swing in net exports has been contributing to GDP growth over the course of this year. A policy question you have to ask yourself is, will officials in our trading partners recognize that the impetus to growth associated with dollar depreciation here is a drag on growth there because it's associated with an appreciation of their own currency? So one could imagine situations in which the United States gets a slightly larger share of the global pie, but the global pie does actually contracts because not all policymakers respond the same way as in the United States. Now, that brings us to monetary policy issues. And I'll make the argument, and if you hear a gasp, it'll be Professor Calomiris is what's going on. And I'm really looking forward to the YouTube version of your presentation where it's Professor Calomiris tells the truth about the rating agency. There are two distinct phases in U.S. monetary policy. There was the last 5 months of 2007. There was the last 5 weeks of this year. Okay. What? In setting policy in 2007, the FOMC recognized, perhaps late, you could argue that spending was slowing, but it was balancing that risk against the risk to its inflation goal. They now release a quarterly survey of FOMC participants, and that goes out at least 3 years. And among what they forecast is PCE inflation and core PCE inflation. And the terminal point to that forecast, what policymakers are thinking for 2010, is a good way of conveying their inflation goal. And the Federal Reserve has an inflation goal, unofficial, unannounced, as we see from here, of something less than 2%. Inflation was running above 2% at the end of 2007, and so policymakers did not respond aggressively to the perceived weakening in spending associated with the housing correction. However, an issue is, because this is not an announced goal, it's an implied goal, it's a goal you infer from their long-term forecast, the FOMC was reluctant to explain its policy easing in terms of the behavior of inflation relative to its goal. Why? Because it didn't want to say they weren't as easing as quickly as might be necessary given the deterioration in spending because inflation was too high. They didn't want to say it because there are considerable tensions on the choice of an inflation goal. That is, the US Congress does not believe the Federal Reserve should have an inflation goal. So in 2007, as they were easing, the FOMC basically protested the expectation of more significant easing in markets, not by talking about its inflation goal because they were afraid to, but rather talking about perhaps the outlook wasn't as bad. And that is perhaps why they didn't get quite as much credit for the easing as they might have. Now, if you look at their forecast in October and their forecast made released just last week, it's darkened noticeably. The expected outcomes for the unemployment rate, for real GDP growth, have all shifted in a way to suggest that they believe the economy has weakened. This has led policymakers to worry about an adverse credit dynamic, one in which problems in balance sheets lead to a deterioration in asset prices. That crimps credit availability and therefore slows economic activity. As economic activity worsens, that further impairs balance sheets. Now, we can put Charlie Calomiris' CV here and Ben Bernanke's CV here, very similar work, and I think an aspect of it is the mechanism is really not thought of part of standard economic dynamics, but rather one that takes hold episodically. If impairment to the balance sheet becomes severe enough, then you worry about it. And I think the difference between Calomiris and Bernanke isn't the quality of the underlying research, it's the judgment of how big is the risk that we're now in one of those episodes. And that's the judgment call. I think that judgment call has been importantly informed by things like the most recent survey of senior loan officers, where Federal Reserve asks loan officers at 60 large, small, medium and large institutions their standards on C&I lending on the left and mortgage lending on the right. And as you can see, not surprisingly, banks have considerably tightened the standards in terms on loans. But not only that, they begin to show through also to C&I lending. So the key judgment here is, has an episode of an adverse credit dynamic taken hold? I think the FOMC now believes that's the case, and they have gone, that means that in that episode then spreads are widening, you have to ease more than you would otherwise. They have gone from balancing risks at the end of 2007 to prioritizing risks in 2008. They're essentially saying the chief goal of the FOMC is to sustain economic expansion and avoid an adverse credit dynamic. As long as that's the case, they've got to ease until markets tell them to stop. That is, they cannot disappoint market expectations of policy ease, and they have decided that inflation is its second priority. They have a hierarchical goal, but it's a hierarchical goal in which growth comes first. Okay.
three excellent presentations. And I would like to give an opportunity first to the panel to, if you have something to say about each other's presentation first, and then open up to the public. Let me add one aspect that has not been discussed here, and I don't intend for this to be done, but I think just for the sake of completeness, we have not discussed the implications of this for the emerging markets in particular. By the way, we are planning to have a follow-up on emerging markets on April 24, I think. I just wanted to point out and maybe hear some reaction from the panelists that, as you know, the emerging markets have been quite shielded from this crisis so far, at least the financial point of view. The stock market have been hit, but the banks are still there. It's something that perhaps was a surprise for many. And there are several conjectures here. One conjecture is that the emerging markets have gone through this before, so there's been a lot of cleaning of balance sheets already in the first place, current account surpluses that perhaps strengthen the situation. However, there is another point of view, since we have somebody like Charlie Calomiris here, I'd like to hear his reaction to that. And the other point of view, which I tend to share, is that in the North, I'm comparing the crisis of 1998, Russia 1998, and how it spread across emerging markets, and now the crisis in subprime, let's call it that way, that has not spread as much. So one possible alternative explanation is that in the North you had a very effective at least in the short term, lender of last resort, which in the emerging markets you did not. And lender of last resort had to operate very quickly. We've seen that they operate very quickly. So maybe that was able to confine the crisis to where it really hit. But the big question, if that is a good explanation, that is high in my mind, and maybe in April we will know much more, so just I'm pushing that one couple of months more, is whether if the situation here doesn't settle, and the market concludes that the lenders of last resort maybe are not as effective as they used to be in the past, maybe because of this globalization that we are talking about and we've seen here, it may have weakened the effectiveness of the G7 central banks. I don't know. I'm not putting that even as a conjecture. But my concern is that if the situation continues, then people will start wondering whether the crisis may not spread to emerging markets, and the problem there is that they don't have lenders of last resort because, in a real sense, because still liability dollarization is an issue. So with that, I would like, as I said, first give an opportunity to the panelists maybe to react very quickly to what you guys said, and then I open up to, and if you want to stand up here maybe so that we all share the podium.
Thanks. I think this was an unusually fact-filled hour or so. It's really been great, and I don't think that there's really huge disagreement among any of the participants. Let me just say a couple of things quickly. In terms of the lenders' tightening of standards that Vince mentioned, well, the standards should have been tightened. The question is, how much have they tightened those standards? All that data tells us is that a very large percentage of lenders agree that standards have been tightened. I would say that should be 100%, that they should agree. But the question is, how much has the marginal cost of funds gone up? And that's where I'm not so convinced. So I don't think that indicator is that convincing. I think Vince articulated something very interesting. It's important. Rick Mishkin was the first one to point this out in a speech, I think, in December. A shift in the Fed's view toward what I would call a movement from an expectational theory of central banking toward a precautionary theory of central banking. That is, instead of targeting based on your expectation of a recession, which no one has forecasted in their models a very high probability of a recession during any of that period, including, I think, the Fed. Instead of targeting based on expectations, saying, well, if there's a 10% risk of a huge negative, let's prioritize it, as you say. And the implicit theory there is we can always take back this interest rate cut. I'm very skeptical. Wall Street's not going to like it, and it's an election year. And I am very worried about that shift from an expectational theory to a precautionary model, because I think it gets the politics exactly wrong. Then Guillermo asked two questions, and I think they're both interesting. One of them is, where are the risks in emerging markets? I always like to start with the politics. I think the biggest risk right now, and I'm sorry to make a partisan comment, I'm a John McCain supporter. I think the biggest risk right now is in the U.S.-China relationship, and it's a U.S.-China relationship worsening as a result of a trade backlash in the U.S. And that means vote for John McCain. But I seriously, I mean it. I think it is a significant risk. John, I hope you're watching. I'd also like to talk about 1998 versus now. And I noticed you're saying about this lender of last resort thing, it's not a coincidence. I think a lot of people are thinking the way you are. Because just this week, there's been new emphasis to try to reform the IMF, to take on a bigger role. And the IMF was sort of left in the background for reasons we could talk about. And the Financial Stability Forum was given a leading role among the G7 in trying to formulate policy to respond to the financial crisis. I think there's a concern that that's inadequate because it doesn't have the resources the IMF does. So just this week, there's been some interesting political change there. But I have a different interpretation of it, which is, I think in 1998, what was happening is the financial intermediaries who had invested in Russia, the hedge funds doing emerging markets, many of them were also the ones who were investing in emerging market securities elsewhere. When they got hit with losses coming from Russia, they had to dump their risky assets, which were other emerging market instruments. So that gave you that connection. Whereas in this episode, it's not the same intermediaries who are hit directly by the subprime collapse as who are the ones who are running the hedge funds in emerging markets. That's a speculation, but it may be. Oh, geez.
I wonder, I mean, I guess if I had to summarize your recent point, which concerns me a lot too, is that these two views at the Fed, they bring about some sort of policy uncertainty. Now, we don't know very well whether the Fed is going to be looking at the financial sector or inflation and maybe shifting from one to the next. And maybe this great moderation period from 1980s starts to change. Is that the
I think it's
okay.
I'd like to hear what Vince thinks about it.
Right. You want to react now, Vince, or you want to hear some?
No, I'm fine. Go ahead.
So my hope is that we've entered a post-gradualist phase. And in the post-gradualist phase, the Federal Reserve should be symmetrically aggressive, being willing to tighten if it does turn out. I mean, I think it is right now it's a coin toss. We're either in or about to enter a recession, or we're in the middle quarter of 3 quarters of growth that average something around 1%. And it is very hard to tell that apart. In both cases, resource slack accumulates. In both cases, the unemployment rate goes up. In the one case, financial markets get better. And in the other case, they don't. And in the case in which financial markets get better and the Federal Reserve is serious in this post-gradualist world, then they're going to have to tighten relatively quickly. They're going to have to, but you'll know that because they'll have to shift from prioritizing risks back to balancing risks. They don't have to say the risks are balanced yet, but they have to take its two goals, and weigh them against each other. So I think that's important. And in that post-gradualist world, they could very well be tightening. And one reason I think that it may be easier than in other episodes is to the extent they justify some of their easing because of problems in financial markets. If those problems in financial markets go away, it's very easy to justify taking out that part of the accommodation. and then they can say, we learned the lesson in 1998 and 99, learned the lesson in 2004 to 2005. To the extent that you've eased because of financial markets then give you a reason to reverse that. There was one other thing I wanted to bring up, and that's the term auction facility that one presenter seemed enthusiastic about, and the other not. I think the term auction facility, in which the Federal Reserve auctions off discount window credit for about a month term, and they does it in size on a regular basis, isn't about the discount window. It's about open market operations. In an environment in which you're worried that primary dealers, the ones who normally do the arbitrage that distribute the liquidity through the banking system, if you're worried that perhaps open market operations were less effective because it has two problems. It relies on a narrow set of counterparties, primary dealers, and the collateral it uses is government securities. Just when everybody wants to hold government securities, the Federal Reserve is trying to take them off the market through its open market operations. The TAF helps on both scores. It's got more potential counterparties. Anybody who's a primary dealer and has lending arrangements with a reserve bank, and it can take a wide variety of collateral. Recognize, however, you have your central bank taking risk in a way it hadn't before. It is they take haircuts, but they're taking haircuts on securities that are extremely difficult to price.
And based on ratings.
Yeah. So I think it's an extremely important issue. In some sense, I was struck by how much it's gone under the radar. That you could be in a situation in which your central bank's lending $60 billion a month, and nobody's
against CDS.
I didn't say anything negative.
I had one bullet point that was.
Oh,
okay.
I think that was okay. Maybe. I'll go back.
Here's the.
Rich, would you like to say?
I actually said what I had to say, and I want to thank the organizers for putting this together, because I learned a lot from both. I'd be happy to answer a question from the audience if I have nothing else to add to my remarks.
Okay, well, thank you. We have 5 minutes actually.
So anyone can answer. Since we're not in a recession yet, people are walking away from their homes because of there's a tremendous amount of increase in the value, primarily because there's less credit available than there was before, and also the role of interest and all that. So isn't it possible that it could be in the Minsky moment because the homes will still continue to fall off in value?
Yes, so yeah, I think the answer is, whenever a question starts with, isn't it possible, the answer is always yes. But I think it's not just possible, it's likely. I think housing prices will slip. But you have to look at the regions that you're talking about very carefully. Take Arizona, Nevada, the south of California, and Florida out of the equation. And in most states, even in the United States, you really haven't seen much of a shock. In fact, much of it looks like the cardiogram of Iraq for the last 20 years, not just for the last couple. So some places are going to be hard hit. Foreclosures do matter for housing prices. That's some research. So if you see, as we're seeing foreclosures going up, you're going to see in some areas housing prices declining. So I'm not saying housing prices won't end up declining some. I just don't think they'll decline by nearly as much as people are concerned that they might. The other thing I would say is there's a policy response that should be done here, because we're leaving money on the table. What we should be doing is encouraging people to stay in their homes when that's efficient. And there are some policies that the Shadow Financial Regulatory Committee that I'm a member of has been advocating, and I don't think that they've been undertaken. So there are ideas for how to create deed in lieu of foreclosure arrangements so that people can turn from being homeowners to renters with an option to buy. And that this could be a very effective way to keep people from leaving their homes, to keep that downward pressure from happening. So I had a slide at the end on microeconomic ideas. There are lots of good microeconomic ideas, and Congress is not considering them, unfortunately. They're considering bad.
I'd like to ask, municipal bonds or obligation insured by the government, how come they are dropping so much in this situation here?
Yeah, that's the monoline insurers. the municipal bonds since about the 1970s have been recipients of monoline insurance agreements that have recently been called into question. And so what you've seen, really remarkably, for the first time that I've ever seen, is the yields on municipal bonds have actually gone above treasuries, even though they're tax-favored instruments. So it's kind of remarkable.
Just a quick interjection. The reason why they're in trouble is that the monolines had a very good business, which was to insure people who didn't need insurance, because most municipalities can raise taxes. And then they got greedy and went into essentially getting into structured products and wrapping CDS. So the reason why the municipals are going up is not because they're riskier, but because the companies that have been insuring them, their balance sheets have been compromised because they got into a game other than insuring municipals, which they should. Which is why Warren Buffett, no dummy, is saying, this is a great business, I want to get in it and insure municipals and stay away from the toxic waste. So
that's exactly right. One thing though to be careful about, don't go out and buy municipals because they seem so cheap. Because municipals all typically have rates that are reset. So what looks very attractive could disappear next quarter. So I am not buying any municipals, even though I agree with Rich that these aren't very risky, because the changes in rates are temporary.
Okay, one more question.
I'll direct this question at Richard because he mentioned continued dollar appreciation, but I'm interested in other sectors as well. What's the risk of emerging markets switching their reserves from dollars to euros, and does it matter?
well, that process has begun to occur. I think that it will continue. I think it will be an evolution, not a revolution. I think the share of dollars now in the IMF data is around 60% of global reserves. It was at as high as 68 10 years ago. I think that trend will continue. You have to distinguish between reserve composition as opposed to the other role the dollar plays in the financial system, which is as a vehicle currency in the currency markets, the derivative markets, and the commodity markets. And there, research and history suggests you don't have two or three, you have one. So it will take a lot to just replace the dollar from that role. But I do think in terms of reserve composition that the dollar share will climb, but I think it'll be more or less orderly. I don't see a crash landing there.
The only uncertainty that I would add to that, though, is Southern Europe doesn't look so great right now. Greece is on the verge of a financial crisis, I would say.
It's always in a financial crisis.
Right. But if you look at inflation, has been higher in the southern part of Europe. The fiscal policy is very, very weak. It's not so clear to me that the euro is going to be a stable currency if you go out 5 years.
And let me just also add, when you hold foreign official reserves, you don't hold dollars, you hold dollar-denominated securities. And the fact is, the United States still makes very good securities trading in a very deep and liquid market. There's there's a single European currency, the euro, but there isn't a single European debt instrument.
Or a single European market. They have 12 markets that don't talk to each other.
Well, I